Now, home capital, could it be the elephant in the room when the big Canadian banks report their earnings next week? For a look at how it might play out, we turn to Diana Avigdor, portfolio manager and head of trading at Barometer Capital Management. Good to have you with us again.
Thank you very much.
It's been described as anything but the canary in the coal mine for the big six banks. Does that jibe with your view?
I think I agree with that.
Okay, so will it come up as far as investor concerns when they're going through the numbers?
I think the way we look at things, I think that we believe that the Canadian banks are going to be doing okay. I think that they're going to meet expectations. I think that they, like you, think that there's some soothing words that they must express. And what's going to be interesting to see is whether that's going to work, whether that's going to be enough. Based on the numbers and based on looking at all the different analyst estimates, I don't think anybody's expecting any type of sinister reporting misses. Trading, if you look at the quarter, trading, for example, has been okay, banking has been okay. This home capital issue has come up, say, about a month ago. This is about crisis in confidence and sentiment turn. And global investors love to short Canadian banks, and they're considered to be expensive because they really have a monopoly on the market. We have 5, 6 banks.
So if we know something the Americans don't, which is home capital is not the broader Canadian banking sector, and Canada's banking sector is not the American banking sector, are banks a buy today?
Government really is adamant in trying to sustain the housing market at a level at least where it is now and stop its very, very fast ascent. Anytime you have, they place taxation limit issues, as we've seen in Ontario. Eventually it might work. We got to be careful what we wish for when that happens. Certainly, global rates are not going down. We have Bank of Canada next week. We'll see what Mr. Polas is going to talk about that. I think that plays into how the financial sector trades in Canada. Global investors in Canadian banks have not been right so far. Certainly there is a very dedicated investor base to the Canadian banks because they're stable, because they're good, because they have a nice yield and they've restructured and have cost controls. Whether it's quite a buy, there's a lot of money moving stocks and they're not always sensitive pricers. I think that you can wait. From Barometer's perspective, we have a bit of a quantitative tilt to particularly selling strategies too, because we feel those are very important. You want to have a level where you no longer lose. So our stop losses on positions have been taken us out of the Canadian banks. I think we might want to wait for some price support and some evidence of price support to get back in.
So the evidence of price support would come from the individual stock graphs themselves and that market sentiment. But as a quantitative shop, within that black box model, the secret sauce that you won't share with us directly, what is the key metric that you'll be keeping an eye on to indicate that things are ticking up for the group?
You will need, first of all, to see breadth expanding in the sector. So from a quantitative perspective.
So more buys than sells.
Yeah, you need those flows to come in. You need when the stock is good, it has to act well. Good stocks act well, not good stocks don't act well. And that doesn't mean it's a bad business.
Well, David Burrows has always said on Market Call, stocks that hit 52-week highs tend to continue to hit 52-week highs. Stocks that hit 52-week lows tend to keep hitting 52-week lows.
And on the trading desk, we've been saying new highs make new highs, new lows make new lows. That's by definition, it's with a smile, but yeah.
Paul Bagnall had pointed out that when we look at the U.S. earnings on the banking front, that the net interest margins, we could take the growth that we're seeing there and apply it here. Do you agree?
Yield curve, the steepening of the yield curve is going to play into that and into the NIMs. So recently, and what's been going on in the U.S. With President Trump's daily headlines and what's been happening to the U.S. dollar, it's going to play in with interest rate policy, which will directly affect the yield curve, which plays directly into the NIM conversation. I think that a month ago or two, people would have told you that they had a lot more confidence in rate increases, higher, faster, that perhaps now that's not the case, given that the US dollar has come right back to where President Trump started off his presidency. We'll see how that plays into growth, and we'll see how that plays into interest rates. If the US does not raise interest rates in the speed and how many times as was originally expected, I can't see Canada doing anything in terms of rates, and that will make the yield curve not so steep, not so fast.
Is it Barometer's assertion that the Canadian housing market is in a bubble? And if so, is it going to burst? And if so, is there a Canadian bank that is more exposed to a bursting of the Canadian housing bubble than another?
I'm not sure the Canadian housing market is in a bubble.
Okay, so strike one on that front.
Is it going to burst? That's connected.
So strike two.
I'm thinking that perhaps we stay we stay level. I think that there are other things that affect our housing markets. It's not all foreign buying. Supply and demand. I think demand stays. As long as interest rates don't rally up too fast.
Which you just finished pointing out is highly unlikely to happen anyway. Thank you so much for your time.
Thank you for having me.